thank you for the invitation, Mark and Sylvia. So my paper was on the international status of the euro after the Eurozone crisis, which is perhaps a strange topic to examine, considering that almost everyone is still debating the likelihood of European monetary disintegration, and Mark and Simon will sketch out a very interesting scenario on what will or should happen when the Eurozone breaks up. But an implicit assumption in my paper is that the euro will survive in one way or another. So the question is, to what extent the international status of the euro will be bolstered by the institutional reforms and the policy changes that have been adopted in response to the crisis. And in my paper, I argued that change in the Eurozone's macroeconomic policy regime is key to boosting the international status of the euro. So I argued that, that the Eurozone's monetary policy and fiscal policy remains too restrictive to significantly enhance the international role of the euro. And by arguing so, I challenged a prevailing claim in the literature on international currencies, which states that international currency leadership has to be based on the adoption of conservative macroeconomic policies, as these policies are necessary to maintain foreign confidence in the stable value, the stable real value of the international currency. So by drawing on a recent scholarship on the importance and scarcity of safe assets in the international financial and monetary system, I argued that international currency leadership needs to be based on the willingness to adopt accommodating macroeconomic policies. So the international currency issuer has to be first and foremost the dominant provider of safe assets in the rest of the world economy. And safe assets are very liquid debt securities that contain no default risk and whose nominal debt repayment is therefore certain. And these assets are believed to be the cornerstone of the international financial system and the monetary system, as they perform various very important functions ranging from foreign exchange assets for central banks to collateral used by private banks in wholesale funding markets. And as you can see, three international developments have been responsible for what has been called the global safe asset shortage. The following table shows the final development, the decline in the supply of safe assets in the wake of the global financial crisis. So the crisis revealed that genuinely safe assets can only be produced by the state in the form of central bank money or sovereign debt securities, whereas the safety of private assets produced by the shadow banking system proved to be elusive. The crisis also revealed that not all government debt securities were considered as safe by international financial markets, especially downgrade by Italian and Spanish debt contributed to the global safe asset shortage. So the question is, why did the market for US Treasuries remain the most important market for safe assets, whereas the markets for European debt securities, sovereign debt securities, or at least a significant bunch of these markets, have lost their status as providers of safe assets? And I believe that differences in macroeconomic policy institutions provide an answer to this question. So the Eurozone's fiscal and monetary policy remain too restrictive for the region to become a significant provider, net provider of safe assets. In fact, its macroeconomic policy mix after the crisis has even intensified the global safe assets shortage for reasons that I will explain later. First of all, a central insight of the literature on safe assets is that avoiding complete default is more important than minimizing the potential of partial default through inflation. So the absence of default risk is much more critical in the definition of a safe asset than maintaining the stability of its real value. And this distinction has important implications for monetary policy, because it means that the central bank has to be willing and institutionally able to provide a monetary backstop to the markets for sovereign debt securities. So the central bank has to be able and willing to act as a lender of last resort to the government, who can then guarantee nominal debt repayments by being able to borrow from the central bank whenever it fails to collect sufficient tax income or risks losing access to financial markets. So in this regard, the Federal Reserve's quantitative easing policies provided some kind of assurance to foreign investors that treasuries would always remain secure assets. Another insight of the literature on safe assets is that overly restrictive fiscal policies can have potentially disruptive effects on the world economy, on the liquidity of the international financial system, as austerity policies reduce the supply of public debt to foreign and domestic investors. So they intensify the global safe asset shortage. So again, we can see that rising fiscal deficits by the American government in the wake of the crisis alleviated the global safe asset shortage, which is, in my view, an important reason why the dollar continues to be the top currency in the world economy. But European policymakers have a different perspective on how the region should meet foreign demand for safe assets. Benoît Cœuré, who is a top-level official at the European Central Bank, recently argued that in the Eurozone, sovereign bonds have to be made safe through sound fiscal policies rather than assumed to be safe. And the reason why they have to be made safe, according to the official explanation, is that European monetary integration did not go hand in hand with European fiscal and political integration. So there are currently 19 different national fiscal authorities issuing debt in 19 separate national sovereign bond markets. And partly because there's no fiscal union, macroeconomic policy institutions in the Eurozone have been based on the principles of what is called monetary dominance. So it means that fiscal policy has to play a passive role. It has to be subordinated to the monetary policy of the European Central Bank, who can then retain control over interest rates and pursue low inflation. That is why governments also agree to subject their fiscal policy to all kinds of restrictive policy rules, like the Stability and Growth Pact. In my paper, I argued that most institutional reforms in response to the crisis, like the establishment of the European Stability Mechanism, and of course the Fiscal Compact, continue to reflect these principles of monetary dominance. So they continue to be based on the view that the best way to stabilize sovereign bond markets is to adopt fiscally sound fiscal policies, and that fiscally unsound fiscal policies should be sanctioned by restrictive monetary policy rules that prohibit the European Central Bank from bailing out Eurozone governments or from monetary financing their deficits. So that is also the reason why the European Central Bank was much more reluctant to act as a lender of last resort and to intervene in sovereign bond markets in the wake of the crisis. Of course, we all know that the European Central Bank has been adopting increasing expansionary monetary policies over the past few years. But in my paper, I argued that operational constraints to its sovereign bond market interventions again continue to reflect these principles of monetary dominance, and that these constraints have undermined its role as a genuine lender of last resort to the Eurozone governments. And before arguing why this is the case, and why also these constraints reflect, or primarily reflect, the creditor and export interests of the northern Eurozone countries, let me first show you several graphs that show the influence of the effects of the ECB's monetary policy on the overall fiscal stance in the region. The first graph shows that there's a negative correlation between the annual growth in the domestic money supply between 2008 and 2015, so the money supply measured by M3, and the extent to which governments in the Eurozone have adopted austerity policies, which is measured by the consolidation in their primary budgets. But the graph also shows that even governments in the northern Eurozone countries have been adopting austerity policies despite the fact that their economies experienced a very sharp increase in the domestic money supply. And as a result of these austerity policies, the region's supply of public debt as a percentage of world GDP has stagnated in the wake of the global financial crisis, whereas rising fiscal deficits by the American government have contributed to an increase in the supply of US treasuries as a percentage of world GDP. Now, so the question is, the more recent monetary expansionary measure by the European Central Bank significantly change this picture. I don't believe that is the case as a result of these operational constraints, these constraints that continue to undercut its position as a genuine lender of last resort. So first of all, its decision to engage in outright monetary transactions, its OMT decision, came with various attached conditions. So they would consist only of sterilized purchases of sovereign bonds with a maturity between 1 and 3 years. So they would leave the market for longer-term sovereign debt without a monetary backstop. But most importantly, most importantly, governments would have to adopt harsh fiscal policies because they would have to formally apply for a bailout at the European Stability Mechanism. Although no policy conditions were attached to its more recent quantitative easing policies, it was decided that the ECB cannot buy more than 33% of the sovereign bonds of a single issuer, no more than 25% of a single issue. And most importantly, it was also decided that at least 80% of the sovereign bond purchases have to remain on the balance sheet of the national central bank. But what is behind these conditions? The official reasoning is that these conditions are necessary to avoid fiscal transfers between Eurozone governments through monetary policy. So these fiscal transfers are of course illegal according to the Maastricht Treaty. But what I argued in my paper is that the main reason why these sovereign bond purchases are or could lead to fiscal transfers is that there's an informal consensus in the Eurozone that the ECB's balance sheet has to be recapitalized according to the infamous capital key when it incurs losses on these purchases. But the entire idea of central bank recapitalization is ridiculous. As we know, the central bank has the power to create money in order to absorb these losses, so the central bank can never go bankrupt like a normal central bank can go. A normal private bank can go bankrupt. And in fact, the IMF staff has done some interesting research on what happens when a central bank has negative equity. And the only side effect, potentially negative side effects that they could find is that is a slightly elevated level of inflation and a slightly more expansionary monetary policy. But it is of course a bit strange to defend rules that allow the central bank to maintain very low inflation when the main risk has become global or Eurozone deflation. But it is less strange when we understand who benefits from low inflation. So this graph shows that the northern Eurozone countries have become the main creditors, the international creditors. So they benefit from low inflation as it supports the real value of their foreign claims against the peripheral countries. And their credit to state is of course linked to trade imbalances in the Eurozone. So the Northern Eurozone countries have adopted export-led growth models that have resulted in a rise in current account surpluses, and these surpluses resulted in turn in foreign claims that were used to finance current account deficits of peripheral countries that have adopted more domestic demand-oriented growth models. And you can see, and this is another reason why the Northern Eurozone countries benefit from low inflation, because low prices boost the competitiveness of the export sectors that play a central role in their economy. And then you can see that the current account balance of the Eurozones moved to a very significant surplus, which resulted from a very asymmetric distribution of macroeconomic adjustment costs between the peripheral countries and the northern countries. So to wrap up, I believe that macroeconomic policy has played a very important role in this process. The Northern Eurozone governments have adopted austerity policies as a way to support the competitiveness of the export-oriented sectors, because these policies induce trade unions to adopt wage restraints in collective bargaining. On the other hand, the ECB's monetary policy contributed to a nominal depreciation of the euro, and as you can see on this graph, the decline in the nominal exchange rate of the euro allowed producers in the Northern Eurozone countries to shift their export markets from towards the rest of the world. So in short, I believe that the current macroeconomic policy setup has benefited the Northern Eurozone countries by enabling them to deflect the burden of adjustment to the periphery and to the rest of the world. And I believe that these strongly entrenched interests will prevent the Eurozone from becoming a very important net provider of safe assets to the rest of the world in the nearby future. As you can see, in order to become a net provider of safe assets, a state or region has to sell more assets than it purchases, so it means that it has to run a surplus on the debt securities balance. And because the Eurozone current account balance moved to a very significant surplus, its debt securities balance moved to a significant deficit. So that means, in plain English, that the Eurozone has become a net purchaser of safe assets. So this stands in stark contrast with the United States, and that is why I believe that the euro will remain a distant second to the dollar for the foreseeable future. Thank you.
Thank you. Kate?
Okay, we're going to switch it up from the program, because I think my presentation slideshow serves as a little bit of a bridge to the wonderful speculative science fiction of the last presentation memo. So I took seriously Mark and Sylvia's sort of framing of this question of whether Europe would remain a helper, would it become a spoiler, and so on, and sort of tried to think about the question in terms of the various scholarly studies that I've done over my career to sort of try to think about how to project into the future of where the EU might be going. So the first thing I think to remind ourselves amongst all of the various wonderful data and empirical work that we've been hearing about is that we should really remember that this broader global financial order is something that is not just about the sort of material transactions at work, but really is about the rules, norms, and procedures that govern all these different types of flows, that we really need to kind of step back a little bit when thinking about these different trajectories and really place it within a broader political context and I would argue as well within a social context. And so I always like to quote Robert Gilpin's, right, quote, "Every international monetary regime rests on a particular political order," because I think it's a very succinct and clear way of reminding us that there are underpinnings to all of these different phenomena that we're talking about today. So how does that sort of help us think about where we are? Well, when we think about the post-war liberal order, I think there's at least two really important particular factors that contribute to that notion of a global financial order that we should focus on. And one, of course, is American hegemony, right? That's the kind of foundation out of which all the different processes that we see at work have occurred. And then the second thing, and the EU is sort of a helper throughout that period, right? Not a challenger. And then the second thing is to really think about the ideational content of that order and the sort of fundamental ideological underpinnings of it. And here we really need to kind of remember that the particularities of the global financial system that we have seen over the past 5 decades or so really rest on a very particular neoliberal cultural foundation. That it's very important to emphasize that that is a historically constructed thing that really we could not imagine the unfolding of markets in the way that they've unfolded in the post-war era without that. And that this has largely produced stability. Now, not stability in the sense, I'm a fan of Charles Kindleberger, hardy perennials of financial crises and so on. But overall, we've seen further integration across markets and so on that have produced a fair amount of stability in the sense of the overall setup of that global financial order. I would note that, I as I mentioned, I think in my comments, I did not see the creation of the euro and the development of EMU as something that had the sort of underpinnings that would allow the EU to actually challenge the US and be that hegemonic actor that would then take on the role of international reserve currency and so on, right? So I did not see that happening, but I saw the euro as something that fit into this equilibrium order. But today, I would argue, we are in a different place. We really are in a moment of sea change, I think, for this Western neoliberal order, potential sea change, right? We don't know what's going to happen. But I do see the EU moving from its role as a clear helper to something that might be more of what Mark and Sylvia term a risk generator. And there are two different reasons that I'm going to unpack in my short presentation because I want to leave time for comments. The first is what I call incomplete political development and the role of the euro and understanding the euro in terms of the EU's overall trajectory as a governance system. And then the second is the populist challenges we are seeing today to neoliberalism. I think both of these things are very consequential, and the first one is much more developed and will sound fairly familiar to you. I think the second one is more of an open question that we're going to continue to talk about. I think Jackie's memo does a nice job of trying to unpack some of that. So what do I mean by incomplete political development? Well, so this is a Rube Goldberg machine, and I would argue the EU is basically a Rube Goldberg machine, right? It's a governance system that has emerged in a fascinating way as an innovative, new, sort of emergent polity, but one that really has no obvious analogy, right? It's not a nation state, it's not a full federal system, but it's clearly not simply an international organization that's set up, with sort of bargains and treaties and so on. In fact, it has taken on an immense amount of political authority over its decades of existence. And it has developed political capacity and power at the European level that far outstrips any other sort of emergent polity that we can see. In my own work, I sort of talk about it in terms of the Hanseatic League, and the Italian city-states, and so on and so forth, that we should think about it in this sort of historic way, and situate it in that sense, noticing that, in fact, many of those preliminary governance forms we don't see anymore, the nation-state one, right? So it's a big open question as to whether the EU will survive. But I think it's very important to sort of start from that point, rather than starting simply from sort of an understanding of perhaps things like the macroeconomic data about the EU. And that's because, of course, if you look historically, and again, a bunch of my work has explored this idea, I argue that actually we should not think in terms of optimal currency areas, but we should think in terms of what I call embedded currency areas. That in fact, historically, the currency regimes that have worked, that have lasted, that have been stable, have always been part of broader state-building political development projects, where currency is really at the behest of the concentration of power to the center and takes its role in part of larger processes of political development, right? So as opposed to, say, you know, the Scandinavian currency union or the Latin currency union or the Austro-Hungarian Empire, right, which had a single currency for a while, that actually it's really nation states that do last with their currencies. And in this brilliant book, The Future of the Euro, edited by Matthias Matisse and Mark Blythe, I have a piece that unpacks this. And this, to some extent, will sound familiar in terms of Matthias's presentation a little bit. But I sort of unpack, well, what is it about the development of a single currency within these broader state-building projects that makes currencies embedded in a sort of Polanyi-esque way, right? That markets are embedded within broader political and social sets of bargains and understandings and social solidarity and so on. So how do we kind of think about what makes those currencies work? And there are at least 4 things that I think we can see from looking empirically and also thinking in a conceptual way about what makes it work. The first is the lender of last resort function, right? Which what I would argue is by far the most developed part of the euro, right? The European Central Bank, you know, I've been studying it for decades, and I was frankly astonished at how sort of aggressive and nimble and innovative the ECB was in the Eurozone crisis. It really surprised and shocked me, having seen it as a much more sort of staid, focused solely on things like price stability and so on. So I would argue, actually, I think differently, I think from you, that if actually that's the arena where we've seen the Eurozone work much more like a standard sort of national setting. But then there are these other things, right? Banking union is also incredibly important for creating this sort of embedded currency within this larger structure of political institutions. And there we've only seen sort of the EU trying to move towards a banking union in fits and starts. But then we get into real trouble, right, with number 3, fiscal union. Again, the history tells us that money tends to be created in tandem with fiscal union within a larger context of war fighting, right, that you need to pay your soldiers, you need to organize your tax revenues, and so on and so forth. The EU, of course, moves towards the euro as a voluntary thing, not during wartime, and it's no surprise that we don't see the political space open up to create competence for fiscal things at the European level. And then finally, political union. We can kind of argue about that, the shortcomings of the EU as a polity, as a set of institutions which have democratic representation and legitimacy. But I think we would all probably conclude that there, too, the EU may leave something lacking. So then the second element I want to let me say one more thing about this. One thing that I think we need to be really careful about is a lot of economists, people like Paul Krugman and so on, look at the flaws of the Eurozone and look at the flaws in the construction of the EU and say things, as actually Matthias said, that you said something about, well, it seems that they thought the best way to achieve these goals was to focus only on the monetary side and so on. And I would argue, no, that wasn't at all. This was not some ideal template. I don't think anyone that I ever interviewed in my fieldwork ever thought that the Eurozone was somehow some sort of ideal type of how to create a single currency. Instead, these things really, this particular structure and its shortcomings were absolutely produced because of the political circumstances by which the single currency came about, right? I mean, this was something that came about with all of its shortcomings because the foundational politics were not there to create the space to create this very centralized, very federalized, very sort of, accrual of power at the European level. There simply was not the capacity or the appetite to do that, right, for political reasons. I remember I interviewed some of the creators of the Eurozone at one point, and they said to me things like, well, of course we understand that there needs to be a fiscal union, but we simply could not see that as a political possibility. But we hope down the line that conditions will create the political will to create a fiscal union, right? So I think it's really important not to just say, this was clearly, not optimal and flawed, when in fact we look historically and realize that these are the product of struggles and fights that happen over long periods of time, and the EU is trying to do something very different in a very different way. Okay, second, I can be more brief here, the cultural foundations of governance. I think it's also very important when thinking about whether the EU will move from helper to risk generator to spoiler. If we think about the underpinnings of the ECB and of the EMU project in terms of the broader emphasis on central bank independence that really took hold in the 1990s and sort of continued throughout the 2000s. I have some earlier work that sort of empirically looks at the spread of central bank independence, which was astonishing in terms of its dissemination as an organizational form, given actually the sort of empirical data about the efficiency and the actual real-world benefits of central bank independence were not at all convincing. And so I argued in my work that the reason why central bank independence became the flavor of the month and was adopted by so many different actors, particularly the new emergent economies in Central and Eastern Europe and the European Central Bank, was because of this broader kind of view in the international system that central bank independence, removing monetary policy from politics, from democratic control, was absolutely the best thing to do, right? And I sort of trace that out in some of my earlier work, and I argue that it's a fiction, but it's a rational fiction, because you do get rewarded, just as perhaps Trump's victory is sort of a rational fiction for the markets, right? You may make money if you get into the market now because it's going up because everybody believes that this is somehow a good thing, but in the long run it may not be. So the question is now is whether the emphasis in these various populist movements challenging the notion of expert delegation and inflation fighting as the key thing that central banks should be worried about, whether that fragility that we're seeing today is actually going to harm the legitimacy of the central bank, of the European Central Bank, given its tight coupling to the culture of neoliberalism. So will the euro survive? Could it be a spoiler in the global financial order is the question I will leave off for our next presentation. And thank you.
Right, well, we don't have a PowerPoint, but we are two Brits, so that means we're genetically predisposed to cause confusion in Europe and see the breakup of the EU as ultimately a good thing. So with that in mind, we decided to write a paper. I exaggerate somewhat. All right, so populism has been mentioned, but it hasn't really raised its ugly head yet. So we're going to take it head on. I've been writing a little bit about populism lately. There's a piece in Foreign Affairs called Global Trumpism. I've got another piece in the European Journal of Economics, and one coming out in Right that tries to put this in a bigger macro context. So I'm going to give some background to what motivated this paper and why we ended up in this space. I'm going to do this in the first part of the paper and then hand over to Simon to talk about it. So the way I see, some of you may know that the first book I did was called Great Transformations, and it was all about basically how the post-war era ended and what were the forces that brought that apart. It was very much agency focused. It was all about agents with ideas and political projects, refashioning coalitions, etc. And the original dissertation version of that was far more structural. It was Shackle and Keynes and Koletsky and a whole bunch of other characters and a very structural story. I'm trying to make sense of populism. I've kind of fallen back into that much more structural story. And I want to just briefly outline what I think's been going on as background. So here's a short version of the story. If the collapse of the 1970s could be attributed to inflation, and basically its effect on profits, the asymmetry between capital and labour, the returns to capital, the effects of inflation on profits, etc., tipping things over. One doesn't have to go the full Kalecki, but you could see sort of those factors in play. Then the regime that's built afterwards is really its diametric opposite. So rather than national capitalism, restricted financial markets, dependent central banks where nobody knows the name of the chief central banker, where labour is dominant in bargaining, corporatist institutions, we really live in a very, very different world. And key there has been the globalization of supply chains and the globalization of labour markets. And beginning in 73, but accelerating in the 80s, you see this break between productivity and wages, which tracked each other very well through the post-war era, and then there's this separation, which is the beginning of the inequality skew. So what's going on there? Well, what's going on there is that you basically have the returns going to one part of the income and wealth distribution, capital gains an upper hand. What else is going on? Institutionally, central banks become very important. We've just spoken about that. So we start fighting an inflation, and that inflation was successfully slayed probably by about 86 with a couple of uptakes after that. But we've continued to fight it incredibly successfully since then, despite there being no inflation in the system anywhere. And I stole this wonderful chart from the Bank of Japan, which I got my hands on. I'd be happy to share with you. And it's incredible. It's interest rates over the globe over 1,000 years. And their estimate of the long-run real rate of interest is 1.5%. And in the 1970s, there's this incredible little blip. Right? And what's happened, of course, we all went to school then and studied that, and macroeconomics changed then. And we've drawn all of our inferences from this one tiny part of the data and then projected it forward and built institutions on that purpose. So, this is why you get Trichet raising inflation, and raising interest rates in the middle of a recession in 2011, because we're hardwired to do it in a sense. Now, the problem with this is once productivity and wages break, how do you basically fill in developed country lifestyles? And if Branko was here, his elephant graph shows this beautifully in terms of what happens to income segments globally. But essentially we fill it in with credit. So this is Alan Taylor's work on the great leveraging, right? Bank assets to GDP, the whole thing goes up, etc. And you just then track that by looking at what happens to commercial credit, household credit. Herman's written a bunch of stuff about this as well. We have a credit boom. And that credit boom goes bust in 2008, and it should have delevered the system, but it didn't because we bailed it. And because of systemic risk and the fear of global contagion and a complete meltdown, it was completely reasonable and rational to do so. But effectively what we've done is basically put band-aids, particularly monetary band-aids, on a system that fundamentally has come to the end of its legs, I think. Now that's when populism starts to come up, because that's the fracturing of that system. That's the reaction to that. Because when you bail that system, not only have you not delevered private balance sheets, you stick them on the state, and then you say, oh, look at all that debt, that's terrible, we have to cut that, and then all the asymmetry goes somewhere else. And you can't borrow more, no matter how far you push down interest rates, and you're still basically creating this very sort of volatility constraint in terms of asset prices, etc., and pushing the whole system in one way. So that's how I think about where the impetus for different types of populism come from. And this is perhaps the breakdown of an order that we've band-aided, but nonetheless may be coming to its last legs. Now, if that's the case, let's put the Eurozone on this. What's the so what? Well, if populism is the result of this, we can say the happy story that's going around Brussels at the moment is we've survived. Number one, the Dutch didn't vote for a guy who looks like Willy Wonka's evil twin. So the crisis is over. So that's great, right? And that's good, but 25% of them still did. And we have the French thing coming up, and I'm still long on that. I think we, as in people who don't want that to happen, will probably go over the line, but it'll be closer than we think, right? And so if I'm right in this, if the structural reading that I've briefly sketched is at all plausible, what it suggests is that these things aren't going away. You can dodge certain bullets, but this stuff's been 30 years in the making. And if that's the case, then something's going to hit at a certain point in time, whether it's next year and the Italians go to the polls, and then someone wants a referendum on the euro. There are multiple trigger points coming up. So the fact that you have a little bit of inflation and growth in the eurozone just now, primarily because of devaluation and energy price increases, that's not really going to stabilize the system. So if we start there, what's the story then? The story, I think, is there's a deeper structural story in this one as well, and it's one that Adam and I have spoken about before, and I published a piece on this in the European Journal of Economics, which basically goes like this. The old olive oil butter line, or if you will, the Catholic Protestant line in Europe, is also the exporters versus people who are trying to be exporters line. Now, the whole of the Eurozone run in a surplus against the rest of the world, but 80% of that surplus comes out of Germany. Now, we know that they're efficient, but they can't be that efficient. So how do they do? 30% of the economy does 80% of the surplus. It's because they didn't globalize their supply chains. They stuck them in Eastern Europe through equity investment. And that means that it's really, really cheap, relatively high quality, relatively close geographically, tied into operational structures which are not attenuated all over the planet. And that's part of the reason why you can get such great elasticities on your exports. In short form, why if the BMW goes up $5,000, you'll still buy it, but if a Chevy does the same, you'll absolutely switch products. So you're able to play that game. Now you're able to play that game and you're encouraging, as we just heard, everybody else to play that game. But one way to think about this is in a kind of growth regimes framework, by which I'm referencing Baccaro and Pontuson's recent piece, for example, or any other sort of bigger structural story, which basically says, you know, there's a reason the French can't do this and the Italians can't really do this, and the Spanish are being forced to do this simply by wage compression, is because these are large consumption-driven, demand-driven, domestic demand-driven economies. And if it's the case that you're trying to push everybody to run the surplus and replicate this export to the rest of the world model, that can work so long as somebody else is allowed to run a deficit. But if you have signed a series of rules and agreement that says deficits are ultra vires, then you've got a bit of a problem. Because if you've got an external surplus, as Puneet will tell us, because I don't know anybody who has balance sheets of national accounts better than him, somebody somewhere on the inside has to be running a deficit. And if you've disavowed deficits, what you're basically saying is we're going to sell BMWs to the Americans and the Chinese and it's going to be great. The Eastern Europeans are going to support us in the council because it's great for them because they're coming from low and then going high. And you guys in France and Spain and Italy are going to run a permanently tight budget to compensate. That cannot end well in a situation where you've got mass unemployment, very low growth, and close to permanent deflation as a structural characteristic. If that's the case, if the euro were then to actually split, what would it look like? Simon.
Nice wind-up.
Tough gig following Mark in full Blythe.
Yeah.
I'll give it a good go. Thank you just for inviting me here this morning. It's great to be here and not in London trying to make sense of Brexit. Susan Strange was actually my tutor on my master's course, what is now quite a long time ago. So to hear her mentioned several times in an hour brought back quite a lot of memories. I haven't thought about it for a long time. Now, how could a country actually leave? Well, as we all know, France's National Front is committed to holding a referendum on French membership of the euro. And as Mark's already mentioned, the Italian opposition, all of the main three Italian opposition parties, are openly questioning Italy's continued membership. Now, we don't know if Le Pen's going to win. I think she probably won't. But no one can be confident about this. No one was confident that, well, people were confident Trump wouldn't win. They were confident the British would see sense and not leave the EU. We don't know what's going to happen in France. It's going to be, I think, tight. And by virtue of it being tight, it could go either way. But even if she doesn't win, as Mark has already mentioned, the underlying structural problems are going to remain intact. It's not as if a narrow defeat for Le Pen is going to address the problems facing France within the Eurozone. Italy, for its part, has managed to escape what is a very modest cyclical upturn in economic activity in the Eurozone. So Italy's managed to escape even that very modest pickup. And the country is rapidly falling out of love with the EU. This is a country that was, one of the most pro-EU ones in Europe, but it's now becoming one of the more Eurosceptic. And we don't know, but it is more than likely that the next general election in Italy will bring to power a coalition government that comprises one or more parties committed to holding a referendum. What would happen then? Well, it's possible that the mere threat of a referendum by France or Italy could prompt the Germans and the rest of the northern core to accept substantive reform of the Eurozone, i.e. a pooling of risk, the issuance of common Eurozone debt, sensible fiscal policies. By that I mean orthodox ones, which I mean internationally orthodox, not German orthodox. Or at the very least, big write-offs of debt. Now this can't be ruled out. After all, they would have a lot to lose from a rupture in the Eurozone. But it would involve pretty seismic shifts in the political positions that these countries, particularly Germany, have staked out for themselves. What happens if they double down on their current position, i.e. rejection of any real kind of pooling of risk? Well, the referendum in France or Italy would go ahead, but the outcome, to be honest, wouldn't really matter that much because just the simple move of announcing a referendum would lead to a massive bank run on the country in question, but also in every other non-Eurozone member state. So you'd see a huge outflow of bank deposits into German banks. Now, the ECB and the Italian, French national authorities could potentially impose capital controls, but probably not before it's too late. And it's worth bearing in mind that the imposition of capital controls between France and Germany, or even Italy and Germany, would effectively sign the death knell for the single currency in any case. Now, the whole process would be massively disruptive economically, politically, legally, but we could then see the emergence of a hard euro based around Germany, the Benelux possibly, including Belgium, we don't know, and some of the Central and Eastern European countries. And a group of, as Mark has termed them, nuevo Euro states in France, Italy, and the rest of the South. Now, what would this mean for the hard euro countries, in particular Germany? Well, yields on German bank accounts, which were already very low, would fall into strongly negative territory as the German banks try to deter inflows. I think the closest analogy for what could happen is Switzerland in 2008, 2011, where we saw massive capital inflows into Swiss banks, which pushed up the value of the Swiss franc dramatically. Now, of course, Germany is a much, much bigger economy than Switzerland. But then the inflows into Germany following a rupture of the Eurozone would be dramatically bigger than the inflows we saw into Switzerland in 2008 and 2011. Now, Germany could just simply stand back and allow the hard euro to become so expensive that it was unattractive to buy German assets. The problem with that is that the Swiss example shows us quite how expensive the currency would have to be to deter those inflows. And a rise in the value of the real euro of anything comparable to the one we saw of the Swiss franc would comprise a pretty major shock to this kind of greater European export complex that Germany sits at the centre of. Now, these exports are generally, but far from exclusively, high value added. There would be, a big hit to export demand if we saw that kind of exchange rate adjustment. They're not price inelastic. The demand for these things isn't price inelastic. So in all likelihood, we would see a big drop in exports, industrial production. At the same time, we would see downward pressure on inflation, which in turn would compound the pressures on the banks in these countries. There are a lot of weaknesses in banking sectors across the Eurozone, including in Germany. Now, Germany would thus face an invidious choice, one that my co-author has termed the vampire's dilemma. See the teeth mark? That is, how to cope with a hugely overvalued currency and deflation, or accommodate foreign demand for its assets. However, Germany wouldn't be able to rely on its banks providing an avenue for those safe asset purchases, because accepting these inflows as deposits would just lead to a further cut in bank deposit rates, which would aggravate already very considerable political tensions over very low interest rates. It's worth bearing in mind that Germans, this is an old society, and people put their savings in their savings banks. And so the fact that interest rates are close to zero, or even negative in some cases, is already a salient political issue. Instead, Germany would have to issue more debt, or bunds. Now this, as we all know, this kind of debt is currently in very short supply, mainly because Germany is running a significant budget surplus, but also because the ECB is buying up a significant chunk of what does become available through its programme of quantitative easing. But with exports and production, industrial production taking a big hit, a big fiscal stimulus will start to make sense for the Germans. And they're not averse to doing that when it's in Germany's interest. It's worth bearing in mind that following the 2008 financial crisis, Germany did provide a lot of stimulus in typically orthodox counter-cyclical fashion. So, they could do it, and they probably would do it. The difference, of course, is that Germany would have to do this on an ongoing basis, not just as a temporary response to an economic shock. Now, that could be a harder policy to swallow, even if it did prevent a further rise in the currency and allowed some export recovery. So, okay, I think what we're looking at in this situation, where Germany would not be able to pull off the US trick of accommodating a lot of demand for its foreign assets without experiencing that much pressure on its real exchange rate. I know that there's disagreement on how much pressure there is on the US real exchange rate, but I think in Germany's case they would see a lot more, because by virtue of their much smaller size. Germany is a fifth of the size of the US. It's never going to be able to issue bunds in anything comparable in quality to the US issues treasuries. It's just not going to happen. And this could be happening at a time when US politics, or Trumpian nationalism, if you want to call it, is making more people internationally question the safety of US assets relative to other assets, particularly German ones. So the pressure on Germany and its fellow travellers in the core of the Eurozone could therefore be global and not just local. They would be kind of expected to act like a hegemon, but they wouldn't get anything like the advantages that the US has had from that status, although, as we've heard, there might be, a limit to that in the US case under current trends. Germany would experience big exchange rate appreciation, but also a very big increase in its exposure to foreign risk. Now, of course, Germany has a lot of exposure to foreign risk, which is the product of decades of large accumulated current account surpluses, but it does have a very, very poor record of investing those capital outflows. German banks, the intermediaries in this, have tended to recycle the country's excess capital savings into low-risk, low-return assets, typically fixed income, and by lending to other banks. Germans have tended to shun equities, and FDI comprises a much lower share of their assets than it does, say, in the US case or in the UK case. As a result, they've earned pretty low returns when times have been good, and then obviously taken a hit when things have gone south. But of course, if Germany is to enjoy some kind of quasi-hegemonic exorbitant privilege, they're going to have to earn significantly higher returns on their investments than they're paying out to foreigners, rather than just suffering the burdens of the asset, of the safe asset provider, which is real exchange rate appreciation and exposure to foreign risk. So they're going to have to get much better in that under that scenario at earning higher rates of returns on their foreign assets. Now, could this happen? Well, if the financial markets are doing the intermediating rather than the banks, then we could see a shift, yes. I mean, they're likely to put more money into riskier, higher yielding assets. I mean, after all, a country doesn't need to be the US to pull off this trick. I mean, the UK, despite running current account deficits for decades, somehow manages to have a reasonably healthy net external asset position. Now, the main reason why it's gone back into surplus lately is precisely for the reason we heard earlier, which was the exchange rate effect. But that's basically because the US consistently earns a lot more on its overseas investments than it pays out to foreigners on their investments in the UK. You can do it, but it would take a very large shift in Germany to bring that about. Now, what would all this mean for Europe as a whole? Well, on the face of it, it does look a little bit like a vampire lending blood to zombies. But it is possible. But is it possible this would be preferable to what we have now? After all, it would force adjustment on Germany and other member states in the core running these large structural current account surpluses. The need to contain their foreign exposure to foreign assets would leave them with no choice but to allow their currencies to rise. They would, their exports would fall. We would see some rebalancing towards consumption. Obviously, if the currencies rise, then imports become much cheaper. That boosts real incomes. So you would see some adjustment. They would have to issue more debt. So we would see a reversal to what has been, wholly unnecessary austerity in the Eurozone since the financial crisis. Second, and I think crucially, the countries with the excess savings and those that have done most to create the disinflationary pressures we have in Europe will be the ones left trying to cope with those deflationary pressures, rather than the countries with the debt and the external competitiveness problems having to deal with the deflation through internal devaluation. So there would be a social equity, social justice angle to this. But, and it's an extremely big but, how to get there from where we are now without blowing up the EU. And it could be possible to dismantle the Eurozone in the way that we've tried to outline in this paper. But it would require an extremely high degree of political consultation and cooperation between the participating economies at a time when that will be in very short supply. What we've outlined here would cause political chaos in Europe. The simple act, as I mentioned earlier, the French doing this would put paid to the Franco-German alliance, which underpins the EU. Now, that alliance is pretty strained and loveless these days. But a Eurozone rupture would, to all intents and purposes, turn it from a loveless kind of marriage into sort of open sort of warfare and antipathy. And without at least working relations between those two countries, it's pretty hard to see how the EU would resist the kind of centrifugal forces that we're seeing right across Europe now. And that would be a tragedy. I mean, we can all, and many of us have, spent a lot of time criticising the way the euro was established and handling the Eurozone crisis, but there's no getting away from the fact that the EU is the principal guarantor of political stability in Europe. Now, all of which brings us full circle. In creating the euro, the proponents have handicapped Europe with a currency that can only really work with a higher degree of political integration than the participating countries are prepared to go along with. And as time goes by, the gap between what it needs and what they're prepared to agree is actually becoming bigger rather than smaller. But it's all but impossible to dismantle the Eurozone without destroying the EU, and hence political stability in Europe. Now, the Americans are not helping either. Some Europeans think that the spectre of Trump, or even Brexit, will sort of act as, will sober people up in Europe and force them to come to the necessary agreements with one another. Maybe, but it could just as easily go the other way. And Trumpism could accelerate these pressures rather than acting as a sort of a warning. We don't know, but I think it'd be foolish for anyone to think that the currency union couldn't crack, couldn't rupture at some point. And if that does happen, Europe is going to face a massively bigger challenge than, you know, who provides safe assets and how to divvy up the pain meted out by deflation. It will be how you sort of maintain stability and peace in Europe. And at that point, the dollar will be even more indispensable than it is now, and the US economy will be even more central. Now, of course, that doesn't mean that that will be sustainable for all the reasons we've heard, but it will leave the US and the dollar four square once again.
Happy, happy, happy. So, pardon me. We're running about 15 behind time, so technically we're kind of still on track almost. Let's do some questions, and then we'll jump to the second panel, and then we'll get to lunch. Who's in? What's on?
I just have a question for Mark and Simon, but obviously everyone else is welcome to chime in at some point. In reading your paper, I don't really understand the logic of why the Nuevo Euro countries would be sort of destined to become zombies. Is there any scenario in which we can envision where they could get themselves out of this position of dependence, and what would that look like?
All right. Short run, at least, they would be. I mean, if you think about one of the main problems going into the crisis was this kind of disguised vendor financing arrangement that was going on between northern savers and southern consumers. And what we're suggesting is that given these tensions between exporters and consumption and then restriction, that you're basically setting up the tension whereby you're going to have to go back to that. So this is the whole analogy of the vampire lending blood to the zombies, right? Because if that fracture happens, it's a bit like, you know, Latin American capital flight. I mean, everything goes through the floor in those countries. Now, over the long term, could you imagine that balancing out and being better for everybody concerned? Possibly, but it's the how do you get there from here. So in the short run, what you've done is you've created a kind of like fiscal prison with monetary dominance and deflation, etc., that you don't like, which is becoming increasingly unstable and volatile, even if it's deeply suppressed by monetary action. But on the other hand, if you were to just let this off, then what would happen is if I'm an Italian saver, I've got some cash, and I get one whiff of this, I'm opening a German bank account. And the very action of doing this destabilizes the system right across, because all the banking sectors are completely integrated. And the banking union, as it stands, has done nothing to basically put fire breaks in that would stop that. So short term, that volatility is going to be expressed as we've mapped out in the paper, which has to be bad news for those economies, short to medium term. If we can sort of put ourselves in a deep freeze, wake up 10 years later and see how the land lies, it might be much better for France, but to get there is going to be extremely difficult.
Assuming you can prevent the EU coming apart, assuming you can, you know, prevent a dissolution of the single market, etc., the whole sort of edifice, then yes. But of course, yeah.
There seems to be an emerging sort of theme over the first two panels of what do we actually want from a hegemon, either global or regional. In other words, the traditional view has been we want stability, we want the issue of safe assets. An emerging view is that we want growth. Now, for different actors, you can finesse that by saying different actors want different things, but there's a fundamental tension there in terms of monetary policy, in terms of actions on growth. So, what do we want from either a global or a regional hegemon?
You want to go?
Yeah, that's a very good question. I would say there's no fundamental contradiction and it depends on, again, how we define a safe asset. So the idea that adopting growth-oriented policies would undermine the position of an international currency, that's only the case if there is very high inflation. But in my presentation, when I argued that, well, in the Eurozone we could, if we really want to boost the status of the euro, we should adopt more expansionary policies. Of course, I'm not arguing for very high inflation, very irresponsible monetary and fiscal policies. I'm only saying that the current policy regime is much too restrictive. So, is there really any fundamental contradiction between supporting or orienting your macroeconomic policy towards growth and maintaining the safety of safe assets?
But before we go to Herman, I want to jump in on this one because there might be, and it might go like this. If you think about a kind of risk-return spectrum on assets under the current way that we do things, so you've got T-bills at one end and you've probably got Turkish equities at the other end, right? And you're making 11% on one and -2 on the other over the long run, right? And that's safe, right? But it's safe because of the policy matrix. So let's say that you do end up with not even just because things are so low, not even that much of an inflation. Let's say a 3% inflation. Let's say you then get rates up to 3%. Then you do expect that rotation out of bonds. And if you get that rotation out of bonds, let's think of periphery banks that have been using Eurozone bonds to basically do their capital cushion, that suddenly loses value. There's lots of asymmetric effects that we could imagine coming out of that type of normalization, in part because we've gone so far out in the curve of preserving this regime as it stands, in the way that I think about it. But that might be one way it might go. Herman?
2 points. If you'll permit me a little bit of product placement, because it relates to the Vermeiren presentation and the question that just came up, and also to the question of the Eurozone breaking up. So Randy and Jermaine and I have a paper in which we basically say that there's been too many words spent talking about international reserve currency, core international reserve currency, in terms of transaction costs and efficiency, and what these things really do is generate growth. The way they generate growth is through chronic current account deficits, the counterpart of which is necessarily some kind of asset sale, which is the safe assets you're talking about. So it's not, it's growth creates stability, right? That's the Minsky argument. Growth creates stability until it doesn't, but that's what international reserve currency is doing.
Yeah.
Okay, so that's number one. The second's not quite as big a point, but you're hanging a little bit of your argument on the price inelasticity of German exports, and Baccaro and Pontusson do actually have some research that say German exports are price elastic.
Yeah.
But even if we say German exports are price inelastic capital goods, the geopolitical consequences of Euro breakup are not going to be very favorable for investment trends globally.
Yeah.
There's going to be massive panic. So those exports are going to evaporate anyway.
Yeah. So
Yeah, it doesn't matter what the price is, no one's going to invest.
I mean, I think when you ask what kind of headwinds we need, the US has been doing pretty much what we need, which is providing growth and safe assets, but it's the only country that can actually do that. But obviously it can't do that if another big part of the developed world is exporting capital on the scale that the Eurozone is. And yes, over time the US is going to become progressively less significant globally, economically, and at some point there will be a challenge. But I think the principal problem at the moment is not the waning of US economic prowess or even political pressures in the US. It's that the other second biggest sort of economic bloc in the world is exporting capital on an unprecedented scale, and that is putting the US under quite a bit of pressure.
yeah, I'm going to go round. We've got two up the back coming down here. So Adam.
I wanted to pick up on this question of what we expect a hegemon to do. And if you're talking about not Kindleberger and co, but Gramsci, one of the things you expect a hegemon to do is to give you a good story. Common sense.
Totally.
And that goes directly to what you're saying, because as it were, the link between the two is the narrative of growth, and the link between the two is the kind of Trump bump confidence effect. And the kind of rather peculiar circumstances we're in now is that we're totally convinced, everyone in their right mind is convinced that Trump is an abomination and means the end of American power, and yet the people with the money seem to be experiencing this soft data surge. Europe actually has higher growth than the United States right now, and yet all the smart money seems to be in predicting its imminent demise. And it seems to me at this point, if we're going to develop a kind of meta conversation about hegemony, it has to include these weird discursive effects where very smart people can go around, and with a lot at stake, politically in Europe, like the future of democracy versus Le Pen or whatever, and on the other hand, in America, a great deal of money riding on this completely bogus view of the world. We are all profoundly convinced. Right? That is part of the characterization of our current situation. Now, the kind of meta level, Gramsci would conclude clearly hegemony is broken, because these people are all out of their minds, right? They can't even agree.
Long
This
and
post-factual
wrong, yeah.
thing is just another way of talking about ideological rupture. Right? That's why it's so absurd. It's this liberal idea that once upon a time facts did correspond to reality, and then now all of a sudden these naughty people don't make them correspond. And obviously the correspondence between facts and reality was always an effect of power, at least that's what critical theory always said. And now oddly we're in this realm in which it doesn't matter, or they systematically don't, or we're in, you know. But that seems to me to be, to place the kind of fantasy you're engaged in, because the devout European in me says, just shut the hell up, Mark.
Yeah.
Like, let's have a we made it bump. Like,
Yeah,
we're growing faster than the United States. I don't
Right.
need your
I
vampire
don't need this
stuff.
anymore. Enough
Like,
negativity.
I just need the Spanish to feel good about themselves again, which they are actually beginning to do, and then we'll get off this reef, and you'll come with Greece and I'll tell you it's tiny, and I don't care. And then you'll come with Italy and I'll tell you that's Italy, and it's a very different problem, and it doesn't have anything to do with the Eurozone, and the break is in 2008, it's globalization, right? And you see what I mean? That
Yes,
we could,
even absolutely.
there's a discursive politics that's involved here, which is why your opening statement, we're Brits and we're designed to blow this up, pisses me off. We know you've done enough damage.
Then stop doing it. No, just stop doing it. Go home and stop doing it. I think Kate should deal with all this.
Yeah, I mean, I'm a social constructivist. My entire corpus of work is, the currency of ideas, all that kind of stuff, right? But just a sort of data point on this, I mean, I was very struck by when the Eurozone sort of starts and Greece is spiraling out of control, that the reaction of political elites in Europe, I thought, was so unattuned to these dynamics that you have talked about. Because, before the Euro began, the deficit levels and the public debt levels of the countries that wanted to join were completely out of line, right, with the Maastricht criteria. But there was a willing suspension of disbelief on the part of markets that, in fact, these countries could do it, right? And so what happened? Their interest rates went down. And so what happened? They could do it, right?
Yeah,
and so there's this in financial markets, I think this relates back to what Dan was saying earlier about, that finance is, to me, so incredibly interesting because it does have these material consequences to these different ideational dynamics. And I think pointing us to Gramsci is always good.
Right.
And shut up.
Jonathan.
Shut up.
Yeah, I'm saying nothing, Jonathan.
Although, I don't know. So,
I have a very different reaction, specifically to Mark's comments, and I want to insist that politics more than economics is going to matter here.
yeah.
And I thought that Mark said something, and then I thought that the panel kind of buried the lead, and so I want to hear the panel's reaction in general to this. Mark went the full Mac Bundy here. He said, we'll get by the French election, but French elections are like cliques, right? That there's just going to be, streetcars going to keep coming along, and one of them's going to blow up, and that will be the thing that unravels everything. And then you guys kind of just started talking about what struck me as kind of more economic-y questions about sustainability. Whereas, is there a political streetcar that's going to eventually come down this pike that will blow up and then everything will unravel? I'm curious to hear the panel's thoughts about the likelihood of that and the consequences.
Do you want two fingers? It's just the same point.
It's a related question because again, that was my takeaway is there's a storm a-coming at some point in Europe, and there will be a crisis. And in some ways, this ties back into something that Ian said in the question from the last panel, which is what does the U.S. do at that moment? And that's one of the things I'm kind of curious about. I made the case that if there was a crisis centered in the United States, that there wouldn't be that much of a difference in the behavior of the Trump administration as opposed to what happened in 2008. I am far less convinced about that if the crisis starts in Europe. And it's worth remembering that in 2008, one of the things that the Fed does is it doesn't just help to bail out the U.S. banks, the Fed helps to significantly bail out the European banks. And so that's I guess my question is, if this happens, and we're asking what is it that a hegemon does, if the U.S. decides it's going to abstain in that moment, and I can see a really powerful case for why it would choose to do so, what happens then?
Just to round out the session, Paul, do you want to come in now or do you want to hold it? Have you got something on the same topic? All right, okay.
I have
So-
a super quick two-favor, but that is the only scenario in which the US dollar gets weaker, I think, because if the Fed opens up swap lines with every other central bank and essentially finances their quantitative easing and massive buying programs, so that feeds into our earlier discussion.
And can I just add a two-finger to that?
That'd be a three-finger.
Sure, two-finger. Is it possible that Russia can make all of them just band together in this loveless marriage, going back to Jonathan's point, because I didn't hear Russia at this, that it's a bad marriage, it's cracking off, but at least for now, let's stick together.
Yeah. Much depends on absolute and relative economic performance, I think. I mean, I'm not saying it comes back to economics, but obviously that is driving a lot of the politics. So if we see what's happening in France, this sense of sort of fatalism about their loss of influence and status within Europe, particularly vis-à-vis the Germans, and some real economic woes. I mean, France is not doing anywhere near as badly as many French people appear to believe, or many British and German and American people appear to believe. In a European context, it's far from being the sick man of Europe that it's portrayed as. But the French have bought into that hook, line and sinker. And unless we see a sustained economic recovery in France, unless we see the French feeling better about themselves and better about their status within the EU, and crucially, unless we can get youth unemployment down in France, which is at grotesque levels, then going forward, these tensions within France and between France and Germany will persist. I think Italy's worse even, because Italy, it's not only that it hasn't grown, but it's losing very large numbers of its young, skilled people. So you're seeing a rapid aging of a country, the loss of many of its skilled people. They're attracting lots of people into the country, but they're unskilled. At the other end, they're losing their skilled. There is virtually no obvious way back to solvency for the Italians within the Eurozone so configured. So those, I mean, these tensions are going to persist. I mean, yes, there is a recovery, and yes, we are seeing, last quarter the Eurozone outpace the US, but it's mainly because the US has slowed more than we thought likely, and we are seeing a cyclical pickup in the Eurozone. It's worth bearing in mind that this does come after years and years and years of very weak growth. Some of the soft data does point to a sustained pickup, and we'll see. A lot of the hard data still look pretty weak. But even if we do have, a reasonable cyclical upturn, what happens come the next downturn? When you don't, all of these underlying tensions, the lack of sort of policy space, the divergence in economic performance, the fact that the countries that are going to be hardest hit are going to have the least policy space to address any of these things, all of that will come to the fore again. So I don't think it's wrong to talk about these underlying challenges. I don't want the Eurozone to come apart. My concern with the Euro has always been that it went beyond the limits of the politically possible in Europe and hence threatened the EU. I think it played a non-insignificant part in explaining why Britain voted to leave the EU, which I resent hugely, because I don't want Britain to be outside of the EU. I think it's going to be very damaging to my country. So I do resent it from that perspective as well.
Yeah. Well, everyone seems to be looking at France, which is of course an important country considering the election. But the question is, even if Le Pen gets elected, I believe that the main reason why she will, or why she would be elected, is not because there's some very strong anti-Euro feeling within France, but it will be because of her xenophobic discourse. So even if she will organize a referendum, I think we cannot underestimate that the majority of the French are still very supportive of the euro. So even if she will be elected, that doesn't mean that France will exit from the Eurozone. And of course, it will create lots of risks, which you mentioned in your paper. But also, even if there will be a scenario of European monetary disintegration, I don't believe it's very likely that France will accept being part of this southern Nuevo Euro group. We all know that the Franco-German axis was very important for European monetary integration. So either the euro will be completely disintegrate, or it will stay as much as possible as it currently is, so in its current form.
I think what happens to France, I think, in that situation is an interesting one. But I think it could only remain in the core if the core then became much more integrated. So, you know, if you saw the South leaving and then you had a core,
And then you have
France
the
would still,
government economy
yeah.
that the French have always wanted.
because
obviously.
without that,
Government
France would,
economy.
I don't think France could sustain membership of a hard euro. I mean, it's struggling within the existing euro. So the idea that it could flourish within an ultra hard one, I think is a bit far fetched. But I mean, I think at that point you might see much closer integration. Who knows?
So first, I mean, I think one of the things that's been so shocking for us EU types, you know, with the Trump administration is these, you know, sort of supposed potential EU ambassador going on the BBC and explaining how he wants to dismantle the EU and so on and so forth. And we're laughing, but I mean, you know, inside the Beltway, I've been to a bunch of different types of briefings from various folks where it's very clear that this is not a joke. And that to me, this actually makes sense when you think about how the EU challenges on a very fundamental level the Bannon worldview, right? Because it's this cosmopolitan exercise of post-national political community that sort of strikes at the heart of what they are against, right? So it's, you know, and these sort of laughable things about them not understanding, you know, that Germany doesn't sort of make trade agreements with the US or whatever. I think it's literally because in their heads they sort of can't wrap their heads around something that is not the nation state. So, you know, so this is very frightening, and I think does contribute very importantly to sort of the notion of the EU with its own problems now no longer has the helper partner of the United States. Secondly, on the EU side, I mean, this is really fascinating and really helpful. But I sort of come back to, you know, the fact, again, you know, that when I look at sort of state building exercises, they're ugly and messy and usually involve people shooting at each other and tanks rolling over fields and things. So to me, the fact that the EU is having all these problems is not surprising given the fundamental sort of assertion of EU level governance into the nation state. But the problem is that the EU does not have the mechanisms of accountability and social solidarity that would allow them to sort of solve all these different problems, right? That it, you know, the notion of referenda, I mean, this is a poor man's democracy, right? Referenda are stupid ways to decide complicated issues. And yet that's the tool that we've seen people reach for in the context of the EU. So I think that, you know, those are the real issues that sort of underlie maybe some of these questions about the euro. And just finally, you know, in terms of the EU falling apart, I think we also have to remember that the EU is not just the sort of tip of the iceberg of the summits and the euro and the things we see, but that, you know, the institutionalization of the EU in terms of the European Court of Justice and in terms of the reorientation of national law to the European level has profoundly restructured all these various national settings in ways that are, you know, I mean, we think Brexit is hard. Think about that, you know, times however many more in terms of, again, unwinding the EU as this really profoundly powerful governance structure. So it's a mess.
Neither of us
Paul
answered.
was got two more and then we'll go on. Paul?
Well, going to raise is a number of you talked about safe assets, and I'm a bit surprised you haven't mentioned.
Speak up a little bit.
I'm surprised you haven't mentioned the Brunnermeyer plan, unless it's died in the past 2 weeks. I just mailed it to see whether it has. So does everybody know about the Brunnermeyer plan? Okay.
No, go for it.
So Marcus Brunnermeyer is a macroeconomist at Princeton, probably Germany's leading macroeconomist. He wrote a paper with a bunch of people about 10 years ago, which was far too complicated, about synthesizing safe euro-denominated assets by basically having securitizations of sovereign bonds. In the last couple of years, he and colleagues put together a much simpler version of the paper, and crucially, with a part of the paper that operationalizes it. That's just a paper. It's close to Mario. He's reasonably close to the Bundesbank. It's been discussed in Berlin. It's got sponsors in the Commission. There are people in Berlin that don't like it. The architects of the idea would ideally like there to be an EU institution that issued these securities. You don't actually need that. I mean, actually, the ECB could set up a special purpose vehicle and do it. I think Mario would have to swallow a bit before he created Europe's safe assets. But, you know, he's a very tough-minded person and doesn't enjoy levitating the euro area economy every day. And watch this space, both for if it collapses, well, if the idea goes away, or if the idea happens. But it isn't a wild idea. It isn't hard. Europe is the second biggest economy in the world. It is the second richest economy in the world, per capita easily ahead of anybody else after the US. It isn't hard to produce a ton of safe assets from the euro area through a means of this kind. The other thing I would say, by the way, just on France, as you and I have talked about this for years, I think it's much more important than Brexit or Trump, and I've thought that for a long time. But no one has mentioned the National Assembly elections or the 2008 changes to the French Constitution, which, I mean, they're virtually in the Sixth Republic. They're certainly in the 5.5 Republic. Before those amendments, it wasn't easy to call a referendum in France. It is now easier. But as I recall, and Simon will correct me, the president can't do it on their own. This isn't a decree power. It's co-owned, and you need a certain number of votes. You don't need a majority in the assembly, but you need a certain number of votes in the assembly. And one of the interesting things about the French political system compared with here is the assembly elections are not on the same day as the presidential elections. So Germany, I mean, if she wins, like you, I don't think she will, but I think she might, Germany will then have 3 months to decide what to do. And this will be a point at which Trump and Xi and Modi will be expected. This will definitely be discussed in the 5 or 6, and those people will be expected to step up to the plate. And it will be a critical moment for this country in terms of the leadership it's capable of providing.
You heard anything about the Bruno Mars plan and you're traipsing through the halls of Brussels?
I mean, I think Schulz and this remarkable surge in popularity for Martin Schulz is interesting in this regard, because this is somebody who, in the past, in a previous life, obviously, in a European life rather than a German life, did express support for sort of proper fiscal federalism in the Eurozone, for Eurobonds. Now, obviously, he's had to row back from that a long way in terms of the German political context. But this would offer the SPD a way of moving forward on this issue without might be manageable politically in a German context. We don't know. I mean, I think it is clearly the best that could happen. It would be far from ideal for all the reasons that but it's the best. It's the best thing out there. And it's now possible that the SPD will actually win. I mean, it looked fanciful up until about 3 or 4 months ago. I don't know how closely people follow German politics, but the SPD were lagging the CDU by at least 10 percentage points until relatively recently. They're now actually leading them. Now, that might not survive the next few months, but at the same time, it does look as though something's happened that the Germans just want to change. And he appeals because he's seen as an outsider. Because he hasn't been in German domestic politics for a long time. He's seen as a fresh face. And he manages to talk about people's concerns without sounding populist. And he's going down quite well. So maybe they'll win, and that would be, I think, him. And if it was him and Macron, sure.
Or even him and Fillon.
Even Fillon.
The French elite is so cohesive. For the first time that I can remember, the French elite are talking about we need to reform to keep this going. I don't know whether they know what they mean.
The post-Bourbon moment.
A post-Enna moment.
Before we go to Sylvia and Ryan, I just want to ask Aaron, do you think red, red, green can happen?
Well, that is the question, right? It isn't Schulz, it's what Schulz would have to put
Yeah.
in his coalition.
Yeah.
And the question now, I don't think so much is the SPD, is whether you can get the kind of quasi-neoliberal Greens on board with the left wing of the Linke, and that's an incredible kind of spread. But that is the
and you can see all of that falling into place if you got
moving
that.
the other way is the report yesterday in the FT about Schäuble, right? I mean, Schäuble, the arch federalist, as part of this electoral tactic, seems now to be moving on to a much stronger, to ward off the AfD threat, presumably on the right.
I thought that was, we want federalism for a small country.
It's difficult, it's been headlined differently.
No, I know. They got it right.
Yeah, they may have got it wrong,
So, Sylvia?
I wonder if I'm the only person in the room thinking about how Europe would respond to something that looks like a US-Russia alliance. So, some of the steam has come out of that lately with hearings, but Trump is such a master at manipulating the US public through propaganda, that I fully expect that fundamental Putin-Trump affinity to resurge, and so I just keep wondering whether, you know, how does that play in Europe? Does that become a force that keeps the Union together, that a force for tremendous sacrifice that might not otherwise be made? But maybe I'm just viewing that all wrong. I'm just surprised not to have heard it.
Well, I had a foreign affairs piece in January where I sort of was looking at, you know, would Trump bring Europe together or pull them apart? And I did talk a little bit about Russia, and I kind of ended up where Adam sort of ended up, as sort of, well, on the one hand, on the other hand, which doesn't make for great journalism, but Katie ran it anyway, which was really nice of her. But, you know, because I think that, you know, again, you know, given my sort of historical look at this stuff, it takes a real existential threat. I mean, it really takes a much more felt sense of existential threat to kind of bring polities together. And it was really interesting to me that they, you know, the Europeans only did the sanctions stuff about the Ukraine after that commercial airline was shot down. I was very skeptical they were ever going to do it, and that did galvanize, right? So, I mean, I never say never, right? But I don't think we should sort of count on it. Does that make sense? Yeah.
No, we are massively behind on time
Okay.
at this point, so
Yeah.
should have
Enough
actually
of
cut that
Europe.
one off. Europe, who
cares?
cares? Exactly.
cares?
Let's now go to the part of the world that actually matters, and we'll go to Asia.
Excellent.